Welcome to F5 Performance Management. In this section, I will go over sources of management information. Companies need good quality information to make decisions. Management accounting information is for internal use, for managers and other decision makers to make decisions with. Management accounting gives much more up-to-date information than the annual financial accounts, which are prepared once a year. That is why it is so important to decision making, that the information is time sensitive. The internal sources of this information are the company's accounting records, so the books of prime entry such as the sales day book, purchases day book, and cash book. Management can find financial information such as the amount of cash versus credit sales during, say, the last month or week, or the profit earned on certain products. Payroll records, so the wages, costs, and the quantity of people and time required to do a task or make a product. Departmental records of incidents, say accidents. Information received from customers, so for example, customer comment cards or complaints. But these records give management more than financial information. They give non-financial information too, like quantities sold and their combinations. Did you hear about the supermarket that from looking at its customer spending patterns, that a popular combination sold was babies' diapers and beer together? They learnt this by looking over the sales registers, the books of prime entry. What did they do with this information? The supermarket then located the babies' diapers close to the beer aisle, resulting in much more sales of both products. If you came in to the supermarket looking for beer, seeing the diapers, you may decide to buy some just in case your baby runs out. So the power of the management information. The company does not operate in a vacuum, and the management must look at information outside the organisation for decision making too. Sources of external information are the government. They provide publications on new legislation, taxation policies, etc. The media. The media gives information about changes in the organisation's industry or technological changes, etc. Financial institutions, giving information on, say, potential customers and foreign currencies. Competitors' financial statements. The internet and public databases. Keeping on top of new information from these sources will help the company make better decisions. Management information, as well as being important for decision making, is a powerful control tool. Both internal and external sources are used. This information is compared to either the budgeted or forecasted results to find the variance and the reasons for the variance. Internal information such as cost reports can be monitored to measure the variances from the budgeted or forecasted results. External information is used to benchmark the company against their competitors. The control process using internal and external information is as follows. Management review the previous month's sales volumes. This is internal information. And they decided to gain 3% more of the market share. Market share information was gotten from external sources. The management now decide how this goal is to be achieved. The next month's sales figures are examined to see if the target has been achieved. This is called feedback. This is internal information. The feedback demonstrates if the company is on target for achieving its goals. Depending on the results, management will go back and amend their original controls to improve on results. This is sometimes called the feedback loop. Management information is a powerful tool, and good decision making will result in more profits for the company. But management information does not come free. The main costs associated with it are direct data capture costs, processing costs, indirect costs. Direct data capture is a data input where there is no data entry. What does this mean? Data from nothing? Not exactly. You are probably very familiar with buying goods in a shop. Here, you go to the cashier with your goods, which are then scanned. The barcodes tell the shop's information systems what you have bought, calculating your bill. The data is inputted into the computer through the barcode reader. It has replaced the cashier typing in everything you have bought. So, direct data capture is great. It saves time. You don't need to worry about spending half an hour at the till while the cashier writes out and totals your bill. But there are costs associated with it. Obviously, there is the initial setup costs and then the linking costs. But being able to read the product codes and total a bill is awesome. But what if it could also be used to update inventory levels, etc.? So link this information throughout the company. This linking cost will also be a cost. The main cost here is the setup of the systems and their maintenance and updating them to keep them up to date with current technology. The data that they collect must also be saved or stored somewhere, so there are storage costs. Processing costs come from processing and analysing the information. This is mainly staff hours. So back to our cashier. The information entered into the till is valuable, but it is only valuable when it is analysed. So someone is employed, like an accountant, like yourself, to analyse and spot trends in the data. The supermarket always had the data that it was selling beer and diapers together, but the information had to be analysed to find this trend. This is very time consuming, but it is very important for the company's long-term growth. And finally, we have the indirect costs of producing information. Information overload creates a lot of indirect costs by either staff getting so lost in the detail and spending too much time on analysing information, wasting time. Poor decisions, which cost the company, can be made from overload of information. Some famous political leaders insisted that information briefs were no longer than 1 page. Giving them the essential information and not overloading them so they could think clearly about the issue. Past data is always being analysed. It is possible that the company becomes so focused on the past that it fails to look to the future. For example, technology and legal changes. These days, external information is obtained through the internet. The internal costs of enabling staff access to the internet is time wasted on non-business activities, security risks from outside the companies through malware that is either accidentally or purposely downloaded by staff. The limitations of using externally generated information. Quality. Information produced externally may not be accurate or reliable. Steps can be taken to reduce this risk. For example, only using reputable sources. But these may be out of date, affecting the accuracy of the information. Information needs of the organisation may not be met because this external information was not created for this company's purpose. Difficulties in sourcing. It may be very difficult in sourcing the external information. For example, detailed breakdowns of competitors' sales will be very difficult to get because companies tend to keep this information confidential. External information is very important for decision making, but its limitations must be remembered to minimize them.